Two Canadians, both with $50,000 invested, both believing in long-term equity investing. The first holds 100% XEQT, the entire global stock market, all sectors, all regions, in proportion to their size. The second holds 80% XEQT and 20% split across three specific sector and style bets: technology, consumer discretionary, and high dividend yield stocks. Both are reasonable, defensible portfolios. Neither is wrong. But they will not perform identically, because the second Canadian is making a deliberate decision to tilt away from the broad market and toward specific areas they believe will behave differently over time. Today we are looking at three of the most popular Vanguard ETFs used for exactly this kind of tilt: VGT, the Information Technology ETF, VCR, the Consumer Discretionary ETF, and VYM, the High Dividend Yield ETF. Important distinction before we go further. These are not individual stocks. They are ETFs, each one holding dozens to hundreds of companies within a specific sector or investment style. We will be precise about that distinction throughout this video, because confusing an ETF for a stock leads to real misunderstandings about diversification and risk. These three ETFs represent three very different bets: growth concentrated in technology, growth concentrated in consumer spending, and stability concentrated in dividend-paying value companies. One of them has quietly outperformed the other two by a remarkable margin over the last decade, and we will reveal exactly which one and why in the next segment. By the end of this video, you will understand what each ETF actually holds, how they have performed, and, critically for Canadians, exactly how to hold them tax-efficiently, given that none of them trade on the TSX. Here is the vault from the opening. The ETF that has quietly outperformed the other two by a remarkable margin over the last decade. VGT. What it is. VGT, the Vanguard Information Technology ETF, tracks the MSCI US Investable Market Information Technology 25/50 Index. It holds approximately 300-plus companies within the U.S. technology sector, weighted by market capitalization, meaning the largest tech companies dominate the fund's composition. What it holds: VGT's top holdings, as of early 2026, include NVIDIA, Apple, Microsoft, Broadcom, and Oracle, typically representing a combined weight of approximately 40% to 45% of the entire fund, given how market cap weighting concentrates the largest companies. The remaining approximately 55% to 60% is spread across hundreds of smaller technology companies, including semiconductor firms, software companies, IT services providers, and hardware manufacturers. What it costs? Management expense ratio, 0.09% per year, extremely low for a sector-specific ETF, reflecting Vanguard's broader low-cost fund lineup. What it has returned? This is where VGT separates itself dramatically from the other two ETFs in this video. Over the 10 years ending in 2025, VGT delivered an annualized return of approximately 20% to 22% per year, driven substantially by the extraordinary performance of mega-cap technology companies, particularly the AI-driven rally in semiconductor and cloud computing stocks from 2023 onward. In 2023 alone, VGT returned approximately plus 54%. In 2024, approximately plus 30%. Even with a more moderate 2025, the multi-year compounding effect has been extraordinary. A $10,000 investment in VGT 10 years ago would be worth approximately $65,000 to $75,000 today, compared to approximately $26,000 to $30,000 for the broad S&P 500 over the same period. Why it has performed this way? And the risk this creates. VGT's outperformance is not random. It reflects a real structural shift. Technology, and specifically AI infrastructure, semiconductors, and cloud computing, has driven a disproportionate share of U.S. corporate profit growth over the past decade. The companies inside VGT, NVIDIA, Microsoft, Apple, have become some of the most valuable companies in human history during this period. But this concentration is also VGT's primary risk. A fund this heavily weighted toward a handful of mega-cap technology names is highly sensitive to sentiment shifts in that specific sector. The dot-com crash of 2000 to 2002, when technology stocks fell 70% to 80% from their peak, is the historical cautionary tale that every technology sector investor should understand. VGT's concentration means it will likely fall harder than the broad market during any future technology-specific correction. Who it is for? VGT is for investors who already hold a diversified core, like XEQT or VFV, and want to add a deliberate size tilt toward continued technology sector growth, understanding explicitly that this concentrates risk rather than diversifying it. It is not a substitute for a core holding. It is an addition on top of one. Your action step. If considering VGT, decide in advance what percentage of your total portfolio it will represent. A common range for a satellite tech tilt is 5% to 15% of total invested assets, and write that target down before investing to avoid the temptation to over-concentrate after a strong run. What it is: VCR, the Vanguard Consumer Discretionary ETF, tracks the MSCI US Investable Market Consumer Discretionary 25/50 Index. It holds approximately 300 companies within the U.S. consumer discretionary sector, meaning companies that sell non-essential goods and services that consumers purchase when they have spare disposable income. What it holds? VCR's top holdings as of early 2026 include Amazon, Tesla, Home Depot, McDonald's, and Booking Holdings, spanning e-commerce, automotive, home improvement retail, restaurants, and travel. Amazon and Tesla together typically represent a substantial concentrated weight, often 25% to 30% combined, given their massive individual market capitalizations relative to the rest of the sector. What it costs? Management expense ratio, 0.09% per year. What it has returned? VCR's performance has been more volatile and uneven than VGT's, reflecting the cyclical nature of consumer discretionary spending. This sector tends to perform very well during economic expansions and underperform sharply during recessions, because discretionary spending is the first thing households cut back on when economic conditions worsen. Over the 10 years ending 2025, VCR delivered an annualized return of approximately 11% to 13% per year. Solid, but meaningfully behind VGT's extraordinary run, and roughly in line with or slightly ahead of the broad S&P 500. The path to that return has been considerably bumpier than VGT's. 2022 was a particularly difficult year for VCR, down approximately 37%, driven heavily by Tesla and Amazon's individual declines that year, followed by a strong recovery in 2023, up approximately 41%. Why the volatility matters? VCR's heavy weighting in Amazon and Tesla means the ETF's performance is disproportionately tied to two individual companies' fortunes, a form of concentration risk similar to VGT's. but in a sector that is inherently more economically cyclical. When consumer confidence is high and spending is strong, VCR tends to outperform. When recession fears rise, VCR tends to underperform broad market benchmarks, sometimes significantly. The economic cycle consideration, consumer discretionary as a sector, is considered cyclical, meaning its performance correlates closely with the broader economic cycle. This is different from a defensive sector, like utilities or consumer staples, which tends to hold up better during recessions because demand for essentials does not decline as sharply. For Canadian investors, this matters because consumer discretionary exposure adds a layer of economic cycle sensitivity that a broad market fund like XEQT, while still equity exposed, somewhat dilutes through diversification across all sectors, including more defensive ones. Who it is for? VCR is for investors who want a deliberate tilt toward consumer spending trends and are comfortable with the cyclical volatility this introduces. Typically investors with a long time horizon who believe in continued growth of e-commerce, travel, and discretionary consumer spending, and who can tolerate underperformance during economic downturns without panic selling. Your action step, if you are considering VCR, examine its historical drawdowns specifically during the 2008 financial crisis and 2022. The magnitude of those declines, 40% plus in some periods, should match your actual risk tolerance, not just your risk tolerance during a strong bull market. What it is? VYM, the Vanguard High Dividend Yield ETF, tracks the FTSE High Dividend Yield Index. It holds approximately 450-plus U.S. companies selected and weighted for above-average dividend yields, screened to exclude REITs. What it holds? VYM's largest holdings, as of early 2026, include Broadcom, J.P. Morgan Chase, ExxonMobil, Walmart, and Johnson & Johnson, a notably different profile from VGT and VCR. Rather than concentrating in a handful of mega-cap growth names, VYM is more broadly diversified across financials, energy, healthcare, consumer staples, and industrials, sectors known for stable cash flows and consistent dividend payments. What it costs? Management expense ratio, 0.06% per year, the lowest of the 3 ETFs in this video. What it pays? VYM's dividend yield, as of early 2026, is approximately 2.5% to 2.8% annually, paid quarterly. This is meaningfully higher than VGT's yield. Technology companies typically pay minimal or no dividends, reinvesting profits into growth instead, and higher than VCR's yield as well. What it has returned, VYM's 10-year annualized total return, price appreciation plus dividends, is approximately 10% to 11.5% per year, solidly competitive with the broad S&P 500, though understandably behind VGT's extraordinary, technology-driven run. The critical difference is in the path of that return. VYM has historically experienced shallower drawdowns during market corrections than either VGT or VCR. During the 2022 market downturn, when VGT and VCR both fell substantially, VCR down approximately 37%, technology stocks broadly under significant pressure. VYM declined by a comparatively modest approximately 0% to -5%, reflecting its concentration in more defensive dividend-paying sectors like energy and consumer staples that were less affected by that particular downturn's drivers, rising interest rates hitting growth stock valuations hardest. The diversification benefit? VYM's sector composition, heavier in financials, energy, healthcare, and consumer staples, lighter in technology, makes it a genuine diversifier when paired with a tech-heavy satellite like VGT. The two ETFs tend to perform well in different environments. VGT thrives when growth expectations and risk appetite are high. VYM tends to hold up better when interest rates rise, growth stock valuations compress, or investors rotate toward value and income. Why dividend-focused investing matters for some Canadians. For investors approaching retirement or those who specifically want a portion of their portfolio generating tangible cash income rather than relying purely on price appreciation, VYM's quarterly distributions provide a visible, spendable income stream. Though, as covered in this channel's previous video on dividend taxation, the tax treatment of U.S. dividends for a Canadian investor depends heavily on which account holds the ETF. More on this in the next segment. Who it is for? VYM is for investors seeking a value and income tilt, either to diversify against growth-heavy holdings like VGT to generate income, or because they have a lower tolerance for the volatility that comes with concentrated growth sector bets. Your action step: if you already hold VGT or are considering it, evaluate whether pairing it with VYM creates a more balanced satellite allocation, since the two have historically performed well in different market environments, potentially smoothing the overall ride. Here is the part of this video that matters most for a Canadian investor specifically, because VGT, VCR, and VYM are US-listed ETFs, and how you hold them changes your after-tax outcome meaningfully. They are not TSX-listed. All three ETFs trade exclusively on U.S. exchanges, MNYSE ARCA, in U.S. dollars. There are no CAD-hedged or Canadian-listed versions of these specific Vanguard sector ETFs available on the TSX. To buy them, a Canadian investor needs either a brokerage that supports U.S.-listed securities directly. Most Canadian discount brokerages, including Questrade and Wealthsimple, support this, or must convert CAD to USD first. The currency conversion step. Norbert's Gambit. Converting Canadian dollars to US dollars through a standard bank or brokerage foreign exchange conversion typically costs 1.5% to 2.5% in spread. Norbert's Gambit, covered in detail in a previous video on VFV and VOO, allows Canadians to convert currency far more efficiently, typically 0.1% to 0.3% in cost, by buying a CAD/USD interlisted security like DLR.TO, journaling it to its USD listing, and selling it for USD. For any meaningful investment in VGT, VCR, or VYM, this is worth doing rather than paying standard conversion spreads. The withholding tax consideration: this is the critical Canadian-specific point. U.S. dividends paid to Canadian investors are subject to a 15% U.S. withholding tax under the Canada-U.S. Tax Treaty. How this withholding tax is treated depends entirely on which account holds the investment. In an RRSP, the Canada-U.S. Tax Treaty specifically exempts RRSP accounts from this 15% withholding tax on U.S. dividends. This makes the RRSP the most tax-efficient account for holding any U.S.-listed dividend-paying ETF, including VYM, which has a meaningful dividend yield, and, to a lesser extent, VGT and VCR, which pay minimal dividends but would still benefit from this exemption on whatever they do pay. In a TFSA, the TFSA does not receive this treaty exemption. U.S. dividends paid into a TFSA are still subject to the 15% withholding tax, and because the TFSA is not a taxable account in Canada, there is no foreign tax credit available to offset or recover that withholding. It is a permanent cost. For an ETF like VYM with a 2.5% plus yield, this 15% withholding meaningfully reduces the effective dividend received inside a TFSA A 2.7% yield becomes an effective approximately 2.3% after the U.S. withholding, with no way to recover the difference. In a non-registered account, U.S. dividends face the same 15% withholding tax. But in this case, a Canadian investor can claim a foreign tax credit on their Canadian tax return to offset Canadian tax owing on the same income, partially mitigating the double taxation effect, though the mechanics require careful tax filing. The practical recommendation? For VYM specifically, given its meaningful dividend yield, the RRSP is the most tax-efficient account, fully avoiding the U.S. withholding tax that would otherwise apply in a TFSA. For VGT and VCR, given their minimal dividend yields, the withholding tax consideration is far less financially significant. A 15% withholding on a near-zero dividend yield is a near-$0 cost, making the TFSA a perfectly reasonable home for these growth-oriented ETFs, where the much larger benefit, fully tax-free capital gains on what is likely to be the larger driver of total return, is fully preserved. The simplified Canadian framework. Dividend-focused U.S. ETFs, like VYM, prioritize RRSP. Growth-focused U.S. ETFs with minimal dividends, like VGT and VCR, TFSA is fine, since the primary benefit, tax-free capital gains, is unaffected by the withholding tax nuance. Your action step. Before purchasing any of these three ETFs, confirm which account you plan to use and apply this framework. Dividend-heavy holdings into the RRSP, low-dividend growth holdings into the TFSA, adjusting based on your available contribution room in each account. Let's come back to where we started. Two Canadians, the first holding 100% XEQT, the second holding 80% XEQT plus a deliberate sized tilt across VGT, VCR, and VYM. Now you know exactly what that tilt would actually mean. VGT, technology concentrated, extraordinary 10-year returns of approximately 20% to 22% annualized, driven by AI and semiconductor growth, but carrying real concentration risk reminiscent of the dot-com era. VCR, consumer discretionary concentrated, solid but considerably more volatile returns around 11% to 13% annualized, heavily tied to Amazon and Tesla, performing well in expansions and poorly in recessions. VYM, dividend and value concentrated, steady returns around 10% to 11.5% annualized, with meaningfully shallower drawdowns and a genuine diversification benefit when paired against growth-heavy holdings, and the Canadian-specific layer that ties it all together. None of these trade on the TSX. All require either direct U.S. securities access or efficient currency conversion through Norbert's Gambit, and the account you choose for each one has a real, quantifiable tax consequence, particularly for VYM, where the RRSP's exemption from U.S. dividend withholding tax meaningfully outperforms holding the same ETF in a TFSA. Remember, these are ETFs, not individual stocks, and they are satellites, not cores. A reasonable approach for most Canadian investors who want this kind of sector exposure. Keep XEQT or VFV as the dominant core holding, and size any combination of VGT, VCR, and VYM as a smaller, deliberate satellite, placed in the account that matches its dividend profile. That is how a sophisticated, tax-aware Canadian investor actually builds a tilted portfolio. Not by guessing, but by understanding exactly what each piece does, how it has performed, and where it belongs.